Hi, Ken Boy with Accounting Accidentally. This video is called Puppies, Gummies, and Mutual Fund Management. So I had a very strange thing happen last Friday. I took my dog for a walk, and about a half hour after we got back, my puppy was leaning back and forth. She was urinating on the floor and appeared to not be able to control herself, couldn't stand up. Took her to the vet. It turns out she had found cannabis on the ground and was actually stoned. She was actually on marijuana. So I thought it was really unusual. And as it turns out, this is a thing. And my vet said this is happening more and more often as cannabis is more and more widely used. There's a cannabis dispensary about a half a mile down the road from me. My dog found it on the sidewalk. So, marijuana intoxication in cats and dogs. With marijuana becoming increasingly legalized and normalized, general practitioners are seeing more intoxication cases than ever before. And the real uncomfortable thing is that my vet has to ask people, are you a marijuana user? Do you have it in the house? Because if you do, it could affect your dog more than once, numerous times. Mine happened while I was on a dog walk. So why bring up the cannabis issue? Well, this is because the impact on pets is an unintended consequence by having legally possessed and used cannabis. This is something that's happening that until Friday I didn't even know about. And I would imagine that many pet owners don't know that this is an issue until their dog gets sick. I've told this story to 3 people. Nobody had ever heard of it. In a similar way, we have unintended consequences when it comes to year-end mutual fund management. Mutual fund trades at year end. So, what's the purpose of these trades? Well, there's a couple of reasons. First, maybe you sell something as a mutual fund manager to take a gain and boost returns for the year. As I record this, it's almost the end of the year. You're a mutual fund manager, you have some gains, you can take those gains and increase the return on the fund. Maybe on the other hand, the sale is to offset other gains with losses. So you have another stock that you have a loss in, you take a loss, the loss offsets some of the gains, there's fewer gains, and that reduces the tax liability. That would be for a stock that's no longer in favor. What about purchases? Maybe you purchase to reinvest sales proceeds because, as we just explained, you've had some gains. So now you're going to reinvest and purchase better performing stocks you expect to perform better over the next 12 months, 2 years. And finally, price earnings ratio, which is the market price of the stock divided by earnings per share. Maybe you're able to find a stock that you like and you can purchase at a lower PE ratio, price earnings ratio, meaning that the stock is relatively cheaper. If you can pay 15 times earnings rather than 20 times earnings, that stock is relatively cheaper. And maybe that has more of an opportunity to increase over the long term. So going to the next slide, realized and unrealized gains. You need to buy and a sell to have a realized gain. So my example here, you have a realized gain if you buy an asset and sell it for more than you paid for it. For example, you buy 100 shares of IBM common stock for 10,000, you sell them for 15,000. Your realized gain is the difference of 5,000, and that's going to be taxable. On the other hand, an unrealized gain has a buy but no sale. We had a buy and a sell here, unrealized gain, a buy but no sale. So if you buy 100 shares of IBM common stock at 10,000, same scenario, hold the stock, you don't sell it. The value increases to 17,000, you have an unrealized gain, and the point here being unrealized gains, generally speaking, are not taxable. So what's the unseen impact to the investor? Well, realized gains in a taxable account, not a retirement account like a 401k, but an account that you have that has interest income, dividends, and capital gains taxed to you each year. A realized gain on a mutual fund in a taxable account will generate a tax liability for the mutual fund owner. Specifically, what will happen is you, as the mutual fund owner, will get a 1099-B, which shows capital gains that the mutual fund has generated on your holdings. You report that on Schedule D of your personal return, which is capital gains and losses. And the bottom line here is that your taxable income increases. Many investors, because this is done at the mutual fund level and not by the investor personally trading, aren't aware of these gains until they get the tax form later on in the year, or they're sophisticated enough that they can pay attention to the statement that they get showing that there are gains after the year end. So this is an unseen consequence to many investors that people need to be aware of. So the key point to remember here is if you own a mutual fund, make sure that you look at your year-end statement and take a look at any gains that the mutual fund generated. Work with a tax accountant and understand what those gains are going to do to the taxable income on your tax return.